Hello, Business 600A students, Accounting and Finance. This is Professor Hassey introducing our week 2 course study for this week, February 6th through February 12th. Our title this week is Business Transactions as we head into Chapter 2, which is the key of all accounting, recording business events, recording the business of your in your accounting language, journal entries, posting to a general ledger, trial balance. We're going to be reviewing this week exercise 2-8 on page 70. We're also going to have student professor meetings this week. If you go to the discussion forum, you'll see a schedule of different dates and times where you can sign up, create a forum, let me know which date and time fit your schedule. And then I will post the names to that so everybody doesn't get the same date and time if they like. And I'll meet with you this Wednesday and Thursday evening just to go over the class, make sure you're comfortable. Maybe also you might have some questions on assignment number 1, and we'll look at assignment number 1 later on in this video. So this assignment 1 is due on Sunday, February 12th. And again, one of the things I'd like to stress in our assignments and our class work, if you need extra time, please feel free to ask. I'm not a big stickler to making sure everything is posted by Sunday evening. If you need extra time, please do so, and I will accommodate you. And it does not affect your grade whatsoever. So we're off and running in just week number 2. A lot going on. We have an assignment looking at journal entries for business transactions. We have student professor meetings and are continuing our study of accounting as we head into finance in a couple of weeks. But first of all, I'd like to show a video of our that's put out by the publisher of our textbook that introduces, by the author of this textbook, introduces Chapter 2, Business Transactions. Let's take a look at that video.
Hi, I'm Paul Kimmel. In this chapter, you're going to learn about the financial reporting process. The financial reporting process is that process that actually produces the numbers that are used to prepare financial statements. Why is this important? Suppose you wanted to invest in Walmart. Walmart could provide you with the billions of transactions that occurred in the last year. This would not be very useful. Instead, the accounting recording process accumulates the information about Walmart's transactions and groups it in a meaningful way. The accounting recording process is referred to as the double entry system. It uses things called debits and credits. This course is about a lot more than just debits and credits, but in order to do well in the rest of the course, you need to become very comfortable with debits and credits. If you practice, debits and credits will become very second nature to you. That will enable you to focus on those things that are more important in subsequent chapters.
Tonight, we're going to be talking about recording business transactions, okay? We introduced it last week, going over transactions and into the format of the accounting equation. Assets equals liabilities plus equity. But the way to actually record business transaction is to record them in journal entries, record them in a general ledger. And that's where you have to take the type of account that it is, asset, liability, equity, revenue, or expense, and apply an increase or a decrease to that account. Now, what's increase and decrease means? It means debits and credits. Debits just mean the left-hand side of the account. Credits just mean the right-hand side of the account. They don't mean anything else. So don't think of them as debits and credits on your Wells Fargo bank statement. They're not that. Those are debits and credits as far as the bank is concerned, not you. So don't even consider that. Debits and credits are a way of recording asset accounts, liability accounts, equity accounts into a journal or a recording format to record the transaction. And you either increase an account or decrease an account. If it's an increase, it's a debit for an asset account. If it's an increase, it's a credit for a liability and an equity account. If it's a decrease, it's a credit for an asset account, and it's a debit for a liability and equity account. Clear as mud, huh? But it just means that those left-hand side, right-hand sides will keep the accounting equation equal. What's an asset account? Asset accounts are things that you own. Remember, we are recording a double entry accounting system. And we talked about this last week. For every entry, at least 2 accounts are affected. 2 accounts for every transaction. Asset accounts are these accounts, things that you own. Liability accounts are things that you owe. Now you can owe a vendor an invoice. You can owe a note or a liability like a mortgage or a borrowing of money. You can owe sales tax and payroll taxes. Those are called accrued liabilities. And you can also owe services. I hope I don't offend anybody here, but has anybody ever done business with a lawyer? All right. And what usually happens when you walk into a lawyer's office? Make sure you, first of all, have your wallet safely covered in your pocket. And at the same time, what happens when you go into a lawyer's office is before they represent you, you have to pay them a retainer. Pay them in advance before they even can do any work for you. When somebody pays you or you pay somebody in advance, you owe the service. So if I'm a lawyer and I take your money as a retainer, that is called unearned revenue. In other words, I owe the service. So whenever you pay in advance for something, it's unearned revenue. Whenever you pay in advance for something, it's called a prepaid. When you pay in advance for something, in other words, the service is owed you. Ever put a deposit down on something? Technically, that's a prepaid. You're putting a deposit down before the service is provided you. It's called a prepaid. If somebody pays you in advance, it's called unearned revenue. Something to always remember. What's an equity account? Well, there's a lot of things going around here. The issuance of stock in the company. Somebody pays you money, in return you give them a stock certificate. They're an owner. You pay dividends to that stockholder. That's a dividend. That's money. Notice, stock is an increase to equity accounts. Dividends is a decrease. Money is going out. If you earn revenue, if you provide a service to a customer, it's called revenue. That's an increase to equity accounts. But if you pay expenses like wages, insurance, rent, that's money going out of the company. That's called an expense. Now, I took these slides right out of your textbook. The PowerPoint is in Blackboard. This is a nice little cheat sheet of what's going on here. Also, I got another cheat sheet for you in the exercise we're doing tonight. But that's the basis for accounting. Is the first task you have to do is, okay, what account am I doing? Is it an asset? Is it a liability? Is it an equity? Now, in the real world, this is all done by computers, and computers figure that out. Any of you ever in charge of a budget? And in that budget, you get the report, and each account has an account number. That account number tells the computer whether it's an asset, a liability, or an equity account. And the computer, once it has that account number, it'll figure it out for you. But we have to understand that before we can get to that point where computers do all the work. So again, equity is the most confusing because there's a lot going on there. Stock, dividends, revenue, expenses. And it's called the chart of accounts. And notice they put these little account numbers. I really don't care whether you guys put account numbers in your accounts in this class. That's not necessary. But as you can see in the chart of accounts, each account, this is how computers get involved. You assign a number to an account, and then the computer knows, oh, that's cash. Oh, that's dividends. Oh, that's rent expense, 640. It's called the chart of accounts. Debits and credits, the double entry system. This is what we're going to be doing this evening. As I said earlier, debits and credits only mean left side of an account, right side of account. That's all it means. So every account, cash, common stock, revenue, expense, liability, every account has a left side and a right side. That's why we debit, that's why we credit. And as I said earlier, here's the accounting equation we learned last week. If you debit assets, you increase it. So if you take in cash, it's always a debit to cash. If you spend cash, it's a credit to cash. Why? You're decreasing the cash account. Debit cash, credit cash. The normal transaction is a debit. Why? Because we're a bunch of greedy son of a guns. We want to receive cash more than we want to spend it. But look at the other side of the equation. The left-hand side for liabilities and equity is not an increase, it's a decrease. It's the direct opposite. Why? Because it's on the other side of the accounting equation. When Giuseppe Debitino invented accounting in Naples, Italy in 1621, Giuseppe, I always crack up, Giuseppe Debitino, he created debits. But wait a minute, he invented accounting. He had to have credits. He married Elizabeth Creditini. His wife was Creditini. She was, you guys are buying this? Don't. It's a bunch of BS. But the nature of accounting is debits and credits.
Want to work?
You guys are supposed to laugh at this. This is fun. This is accounting. It's fun. I get up in the middle of the night when I can't sleep, and the first thing I do is I debit cash and credit something. Such is my life. Okay. But note, going back again, notice for liabilities and equity, debits decrease it. Credits increase liabilities and equity accounts. Credits decrease asset accounts. What a way to make a living, huh? What a way to make a living is to keep track of all this stuff. Good God Almighty. All right. So when you borrow money, what do you get? You get cash. The bank gives you a check and you borrow money from a bank. You increase cash, you increase the loan liability. When you pay off the loan, when you write a check and pay off the loan to the bank, you credit cash, you debit liability. You're decreasing the liability account because you're paying it off. See how that works? When somebody gives you money for stock in your business, they give you cash, debit cash, and now they are an owner of the business common stock, credit common stock. Equity increases. They've given you money and it's called stock for cash. When you pay that stockholder a dividend, you credit cash, you write a check, and you pay dividends out of the business, debit dividends. When you take in revenue, somebody gives you money, cash, you provide a service revenue, credit. When you pay somebody wages for working for you, you write them a check, credit cash, debit expenses. Money is going out of the business. Credit revenue, debit expenses. Credit stock, debit dividends. Wow, unbelievable. Our job this week is to practice this and understand it. Here's again some examples. Take a picture of this. This is a good cheat sheet as well. So here's an account. Here's all the transactions of an account during the course of an accounting period. Debits is cash coming in, receiving investment by an owner, providing consulting revenue, collection of a receivable. Somebody owed you money. That's money coming in. This is money, cash going out, credits, the purchase of supplies, equipment, rent, salary, accounts payable. We're paying a loan, paying a dividend. The total of these accounts, 36,100 debits and 31,300 credits, gives you the account balance, $4,800. There's $4,800 of cash in the business at the end of all these transactions. Money coming in, money going out. The difference between the two sides is on the debit side, debit balance, 4,800. If you ever get a credit balance in a cash account, you've bounced the check. There's no money there. So that's why you don't usually see credit balances in cash accounts unless you work at the University of Laverne. Ha ha ha, that's a joke. All right, you don't usually see credits in cash accounts because you want to always have at least some money there. So we take accounting information, we organize it into accounts, we record an entry, and we post it to the ledger. At the end of chapter 2, there's some great examples of this process. Cheat sheets, I might say, at the end of chapter 2. So if you have a textbook, at the end of chapter 2, they give examples of these transactions right through the general ledger and the trial balance. Those are perfect examples of this process. That's how it works. Journal entry, account balance, posting to the ledger. The general ledger is a group of all the accounts that you keep track of all these transactions. And then when you're done with that, you put them into a trial balance. So these are all examples in your textbook that they show you this. We're going to do now a sample from one of our exercises at the end of the chapter. Okay, so let me bring that up. First of all, I will post this to our in-class review. This is a spreadsheet that we're going to fill out. This is very similar to the assignment spreadsheet that I give you to do this week. I put in all the stuff. You just have to fill it in with the correct information. Okay? And also here, I gave you a little sample of that accounting equation in a journal entry format. Then we're going to post them to the ledger of accounts, and then we're going to prepare a trial balance. What is a trial balance? This is the PDF that I put into the file, but if you don't have a textbook, what we're going to do is we're going to do this exercise 2-8. We're going to prepare journal entries for June 1st through June 30th. We're going to take these transactions and record them in a journal entry format. Then we're going to post them to the ledger of accounts, and then we're going to prepare a trial balance. What is a trial balance? It tells us that everything is in balance. Doesn't necessarily tell us that everything is correct, but it tells us we did everything in balance. And I'll talk about that in a minute. So here's a series of transactions for the Sustain company. We're the accountant. We're going to record these entries. All right? And we're going to record them in that spreadsheet that I just showed you. So you can follow along with this from the textbook, or you can just watch and review this later. But notice June 1st, T. James owner invests 11,000 cash in the company in exchange for common stock. That's a business event. The owner has invested $11,000 of cash and in return gets some common stock shares. They're an owner of the business. Well, how would you record that accounting wise? Here we go. Let me make this a little bit bigger for you. All right, this is June 1st. Always record the date or the transaction. Now, what did we get? We got cash and we got common stock, right? We got cash and we got common stock. Cash, debit, $11,000. Common stock, credit, $11,000. All right? That's the journal entry. We just recorded a business event. We increased the asset cash by debiting it, and we increased equity by crediting common stock. See how that worked? That's a business transaction. In the real world, this is done by computers. But we got to know how the computers do this. And that's the recording of the business event. Short and sweet. Now, notice what I do next. After I do this transaction, I now have to go to the ledger. The ledger is a group of accounts that the company has. And you keep track of all the transactions in these group of accounts called the general ledger. So now I'm going to post this transaction to the general ledger. What did we do? We debited cash 11,000. We credited common stock 11,000. So I go to the ledger, type in June 1, and I put in $11,000 as a debit to cash. And now I go to the common stock account. Here it is right here, June 1, and I post a credit to cash, $11,000. This is where I summarize all the transactions for the period of time, in this case, the month of June. Again, you record the business event in a journal entry, you post to the general ledger. And now we're going to keep track of these throughout the month of June. Any questions up to this point? Okay. Very good. The good thing about this is you guys don't have to worry about any setup. I give you all these sheets. All you have to do is fill them in. June 2nd, the company purchased $4,000 of furniture made from reclaimed wood on credit. Ooh. Does it say anything there that we're spending cash? No. It says we're purchasing $4,000 of furniture made from reclaimed wood. I don't know what that's supposed to mean. But here's the key. On credit, meaning we owe the money. Invoice City. We owe the money. So let's go to our journal entry. So on June 2nd, what did we get? We got furniture, an asset account for $4,000. Debit. And what's the credit? Accounts payable. $4,000. All right, Mr. Hasse, explain. They tell us that we purchase furniture, which is an asset. We own the furniture now. In exchange, they bill us. We bought it on credit. Whenever you see the words on credit, think accounts payable. when you purchase something. It means we owe the money. We probably have 30 days to pay this sucker. Credit accounts payable, which is a liability account. Asset, furniture, liability, accounts payable. We owe the money on credit. So let's post this to the ledger. Where's furniture? Where is furniture? Oh, it's supposed to be here. Sorry. There it is. Whoops. There it is. Furniture. June 2nd. We purchased $4,000. That's a debit to furniture. And where's accounts payable? There it is right there. June 2nd, a credit to accounts payable of $4,000. We now have posted this journal entry to the ledger, and it's in the account in the ledger that you used in your journal entry. Okay? Let's go to June, next one. June 3rd. The company paid, here we go. You can tell this is a graduate level class. Here's why. We would never have this transaction in a freshman accounting class. They'd be jumping out of the windows if we did this. They wouldn't know what's going on. You can tell this is an MBA class because they're giving you some heavy duty stuff right off the bat. And here it is. The company paid $600 cash for a 12-month prepaid insurance policy on the furniture. So we bought an insurance policy. You guys know this. What do you do when you pay Geico your automobile insurance? You pay them in advance. What do you do when you pay your rent or rent insurance or your home insurance? You pay those son of a guns in advance. And then over time, that insurance will be used up. That's called a prepaid. It's an asset account. We're paying $600 in advance on an insurance policy, and we're paying cash. So here's the journal entry. June 3rd. Notice I always put the debit accounts on top. It just looks prettier. You don't have to do it that way, but I always do. So notice we're going to debit prepaid insurance. Why? Somebody owes us the service. We're paying in advance, $600. At the same time, we're paying cash to buy the policy. Credit, cash. So notice in this transaction, liabilities and equities are not involved. It's all on the asset side of the accounting equation. We're paying in advance for an insurance policy called prepaid. That's an asset account. There it is right there. At the same time, we're writing a check, giving that money to the insurance company in advance, $600. The insurance company now owes us the service of insurance in the next 12 months for $600. When we next week in chapter 3, we discuss how we adjust these accounts with the passage of time. But now we're just recording them when they actually occur, and we're paying in advance for this insurance policy. Let's go to the ledger. Prepaid insurance, there it is right there. June 3rd, $600 debit. And then June 3rd, $600 credit. We now have a balance of $10,400 in the cash account. Two entries, a debit and a credit. What's the balance? $10,000, $10,400 debit balance in the cash account. And there's the prepaid. There's the stock. There's the furniture. And there's the payable. The ledger is beginning. Any questions on that one? Prepaid, an ugly account. A lot going on there. Let's look at the next transaction, June 4th. The company billed a customer $3,000 for sustainability services provided. Oh, I get it now. This company's name, Sustain Company. Oh, okay, I got it. They're providing sustainability services. They billed a customer for $3,000 for services provided. Wow. Let's take a look at that one. June 4th. We billed services. I don't see any mention there of cash. Accounts receivable. Somebody owes us $3,000. We billed a customer. We gave them an invoice. And we're going to credit services revenue. Even though we didn't get paid cash, it is still revenue. Why? Because we provided the service. We did the work. We did the service for this customer. It doesn't matter whether we got cash or not. We still provided the service. It is revenue. And we show in the transaction that the money now is owed us. $3,000. Accounts receivable. Let's post this to the ledger. Accounts receivable, June 4th. $3,000 debit. And now services revenue. This is revenue, equity account. Revenue is being, or equity is being increased, so it's a credit. $3,000. Debit, receivable, post, credit, revenue, post. We've now posted that to our ledger account. So now we have two assets. Prepaid, the service is owed us. What's the service? Insurance. Receivables, the service is owed us. Cash. Eventually we're going to get cash for this. We provided a service. Somebody eventually is going to pay what they owe us. Receivable, probably in 30 days. The business is beginning. Can you imagine how many journal entries there are for a company like Walmart? Good Lord Almighty. That's why computers run the show. Let's take a look at the next transaction, June 12th. And again, these are examples of what you'll be doing in your assignment this week for Sunday. So this is practice. And you have these as your notes for that practice. June 12th, the company, oh, here we go. The company paid $4,000 cash toward the payable from the June 2nd furniture purchase. Oh yeah, remember on June 2nd, we purchased $4,000 on credit. We owe the money. Now on June 20th, on June 12th, we're paying that bill. We're paying the liability on June 12th, $4,000 cash. Entry. June 12th. Debit accounts payable. $4,000. Credit cash. $4,000. What are we doing? Remember this transaction here? We bought the furniture. We owe the money. Now on June 12th, we're now paying the bill, writing cash and reducing. Now we don't owe anything. The liability has been paid. Debit liability, the liability is being decreased. Credit, the asset cash, the asset account is being decreased. Ingenious. Let's post that to the ledger. June 12th, cash, credit $4,000. June 12th, accounts payable, debit $4,000. So what's the account balance in accounts payable now? It's zero. We've paid the bill. What's the account balance in cash? We're losing cash. It's now $6,400 because we've reduced cash by paying that $4,000 debt. And our cash balance is that. We better collect this receivable. Okay. Question.
Hear me?
Alex. Yep.
Sure. So what happens to the section where you have the furniture? Do we subtract?
June 20th. The company collected $3,000 cash for the services billed on June 4th. What the hell happened on June 4th? Oh yeah, the company billed a customer for services provided $3,000. Now on June 20th, that customer is paying us. Cool. I like that. Journal entry. Oop. Journal entry. June 20th. We are receiving cash for $3,000. They're paying us the bill. What else is happening? They're paying off the receivable. Accounts receivable, credit, $3,000. They no longer owe us the money. We still earn the revenue. Now we're collecting the cash for that billing. Debit cash, increase asset, credit receivable, decrease asset. They no longer owe us the money. Let's post that to the ledger. June 20th, we got $3,000 cash. And June 20th, the receivable is being paid off. Credit. What's the balance in the receivable now? Zero. Nobody owes us anything. What's our balance in our cash account? All right. We now have $9,400 in cash. It's gone up. We collected the money. Cool. I can smell. I smell it. I can smell accountants in the audience. We're becoming accountants. Definitely a nice smell, a fragrance of people understanding accounting. All right, let's continue. Let me save this. Trust me, after you do some of these, always save your file. There's nothing worse than doing all this work and then you do something stupid and the file disappears. Always go up, make sure you save the file as you do these problems. It can be very frustrating if you lose it. Trust me, I've been there. All right. Let's go to June 21st. The month is almost over, thank God. Here we go. T. James, oh, he's the owner, invested an additional $10,000 cash in Sustain Company in exchange for common stock. Oh, so more money is coming into the company in the form of a stock investment by the owner, $10,000 cash, just like we did on June 1st. Entry. June 21st, cash, debit, right? Money's coming in. This time, 10,000 bucks. All right. And again, we're going to credit common stock. Owner investment in the business, credit $10,000. Cash is being increased, debit asset. Equity is being increased by stock, credit equity. Let's post that. June 21st. Debit cash, 10,000. Our balance now is, we're loaded, $19,400. And credit common stock. Some additional investment by the owner. Credit $10,000. So now our balance is $21,000 on the credit side of equity common stock. Cash, stock. Debit balance, credit balance. And now the final entry for our month, and then we can close the books. June 30, the company received $5,000 cash, here we go, in advance of providing sustainability services to a customer. So a customer is paying for services that we have yet to perform. They're paying us $5,000 in advance. They're giving us cash, but they're paying us for a service in advance. Remember up here, we bill the customer for services provided. Here, a customer is paying us in advance. The services have yet to be done yet. Journal entry. June 30th. We got the cash, debit, $5,000, but it's not revenue credit because they've paid in advance for it. It's called unearned revenue. Credit, $5,000. We've incurred a liability of unearned revenue. We owe the service to this customer. They're paying us in advance. This is just like the lawyer retainer thing I was talking about. Somebody's paid us in advance before we've done the service. We got the cash, cool, but we owe the service. It's a liability called unearned revenue. When the University of Laverne hounds you in the last couple of weeks to pay your tuition or have tuition completed before you started this course, when they get your money, be it in financial aid, grants, or a check, it goes into what? Unearned revenue. Why? I haven't taught you yet. You haven't taken the course yet. Then, according to the guidelines of Laverne, after 4 weeks, after you're still in this class for 4 weeks, that money now becomes a service provided. And they have to do a correcting entry, an adjusting entry, to take it from unearned revenue to earned revenue. Same thing with this. Debit cash, credit the liability, unearned revenue. Let's post that to the ledger. June 30th, cash debit, $5,000, and credit, credit, let's put it here, unearned revenue. Liability account, June 30, credit $5,000. We owe the service. So now the cash balance is $24,400. The unearned revenue balance is $5,000 credit. And now we've completed all the transactions for the month of June for this company. Nice spelling, Mr. Hassey. Journal. There we go. We've recorded the business events of June. We've posted them to the general ledger. Now we're going to make sure that everything is in balance. It's called a trial balance, where we record all the account balances in our ledger. It's called a trial balance. This is a check for the accountants to make sure everything, the ledger, is in balance. So let's go back to the ledger. Cash account, a balance of $24,400. Let's put that in the trial balance. Cash, $24,400. That's the account balance in the cash account. What's our next balance? Receivable, 0, no balance. Prepaid, there we go. Prepaid has a balance of $600. Debit, let's put that in the trial balance. Prepaid insurance, $600. Back to the ledger. What else we got? We got that furniture, Alex, you were talking about earlier. The furniture, we still own it. $4,000 debit balance. Let's put the furniture in our trial balance. $4,000. Okay. What's next? Nothing there. Up to the top, accounts payable. Nope, that's a 0 balance. We paid it. Unearned revenue has a balance of $5,000 on the credit side. Unearned revenue. Let's put that in the trial balance. Credit, $5,000. That's the account balance. What next? Ooh, common stock. Credit balance, $21,000. Cool. Put that in the trial balance. Common stock, $21,000 on the credit side. Cool. What else? Dividends? Nope. Service revenue, $3,000. That's service revenue that we provided a customer and got billed for it on June 4th. Okay. Service revenue, credit balance. Let's put that here. $3,000. Anything else? That's it. We've now taken our ledger balances and put them in a trial balance and listed them. Now let's see if they all are equal. Let's put in a sum figure here. $29,000 on the debit side. The moment of truth, drum roll please. Wow, $29,000 on the credit side. You've done A work. You've recorded the business events. You've posted them to the general ledger, and you've shown me a listing of all the account balances, and they're in balance. $29,000. Ladies and gentlemen, Madame and Messieurs, this is Chapter 2. Okay, now that video, or that part of this video, is recorded from a prior class about a year ago, and I incorporated that in this video, this introduction video for week 2. But you could see the exercise 2-8, page 70 of the textbook, and we walk through it. And let me show you where that is in Blackboard. If you go to week 2, under in-class review, there's the problem, and there's the spreadsheet that I did the exercise on. So that's a good template to learn about recording business transactions this week. So that's where that information is from this video that I just showed you. Next week, we'll take a look at adjusting entries in Chapter 3 and completing the financial transactions by doing financial statements and recording the close of the books. That's in week 3. This week, though, Chapter 2 recording business transactions, and that exercise I just did is now here in your Blackboard, and you can use that as a study guide. Because now, as you remember, in assignment, we have our first assignment this week, which is an introduction to accounting. It's due on Sunday, February 12th. That's not 5th. So let's make sure we change that right here, right now. That's ridiculous, Mr. Hassey. Due February 12th. Okay. Okay, so that's I've updated that. That's due Sunday the 12th, not the 5th. So that's the assignment you do, and we're going to look at that in just a minute. So right now you have two things going on this week. You have in the student discussion forum, you have a list of date and times to reserve to meet with me for about 5-10 minutes, just to get up to speed and make sure we are all on the same page about our course and the work that needs to be done. And if you have any questions about the Blackboard or our schedule, so please select these times in the student discussion forum for either this Wednesday or Thursday, or excuse me, this Wednesday or Thursday, February 9th. So you want to select a date and a time. Now, if any of these dates and times for Thursday and Wednesday of this week don't work, then just contact me and maybe you can get together with me over the coming weekend. But I'd like to get everybody done. We have 7 or 8 students in our class, so we can all meet this for about 5 or 10 minutes this Wednesday or Thursday night. So what you want to do is you want to open up this discussion forum, create a thread, and put your name down on the thread under subject, your student name, and then the date and time that you would like to meet me. And then you submit it, and then everybody can see your selection, and I can put you on our calendar, and then you click on this Zoom link. This is our student hours Zoom link, by the way, that's in the syllabus. Click on that link and you can see me at that date and time. We'll just chat about the course. This is for a grade, 5% of your course grade. So don't blow this off. You get some credit to your course grade by coming and meeting me this week. That's number one. Number two is to do the first assignment, very similar to the exercise we just did. And it's in assignment number 1 in the assignments file folder. This is due on Sunday. It represents 10% of your course grade. And this is what the assignment looks like. It's in 2 parts. The first part is multiple choice. Select the best answer. You have about 18 or 19 multiple choice questions, mainly about the definition of accounting, some key points about understanding what accounting is all about. These multiple choice questions, there they are right there. Select the best answer, circle it, or however you want to do it. And there it is, 20 questions, 20 questions about accounting, definition from chapter 1. Then you have a second part, just like the exercise, somewhat what we just did. I want you to record these journal entries for this company for the month of April. So there's April 1st through the 29th, the series of journal entries. I give you the accounts that you can use right down here. You don't have to worry about posting to a general ledger like we did in the exercise. You don't have to worry about posting to a trial balance. Don't worry about that. We'll worry about that next week. This week, all I want you to do is record the journal entries. So you can set up a spreadsheet in a Excel or Apple Numbers file and just just like we did in the exercise, or you can go into the exercise in Blackboard and download that spreadsheet and incorporate it and use that template to do the answers here. However you want to give it to me, I want to see the journal entries, account, the date, the account, the debit or the credit, and the credit to show me the accounts of these transactions from April 1st to April 29th. So you're recording these journal entries. This is 60% of this assignment's work. So multiple choice definitions about accounting. And part 2 is to actually record journal entries for this company for the month of April and into a spreadsheet or some type of journalized document. So you can give me this document back. You can download the document. It's in a PDF and Word doc format. You can download that and then circle the questions or highlight the answers to the multiple choice and then record the journal entries. Or you can just download this, do the multiple choice, and then create another file for your journal entries and submit that as well. So that's assignment 1. It's due on Sunday at midnight, February 12th. So all you need to do is once you complete your work for assignment 1, you go to the assignment 1 file folder, click on that file folder, and go to submit. You browse your files, find the file you want to use or the file or files, multiple files that you have your answers on, hit open, and then that'll upload it to the Blackboard. You hit submit, and now I have your work to grade. So that's how all this works. And I'm sure some of you have done this before in other classes. If you have any questions on what the file should look like or how to upload it, just let me know. We have our meetings this week that you can ask me questions and get some information, or just send me an email and I'll be happy to do that. So now it's all set up in week 2. You can create a meeting time for me this week. You can do your assignment 1 and you can review this video about our class and the sample problem, exercise 2-8, and look at that work as well. So thanks, everybody. We'll be talking to you later on this week in our professor meetings. I will have another video posted on Friday, which wraps up this discussion for our second week. Have a great week. We'll see you later. Bye-bye.